Hi there folks. On the 1st of Jan 2026, the UAE brought into force a Research and Development Tax Credit. It is the first of its kind in the region, a legislated non-refundable credit of up to 50% on qualifying R&D expenditure, with a maximum benefit of 2 million dirhams of tax credits per year. Now the legislation is live, but the full operational rulebook, Ministerial Decision 24, was only published in March 26. So the complete picture has been available for a matter of weeks. Now today, I'm walking you through both pieces of legislation, article by article, covering exactly what the rules say, what the numbers are, and where the traps sit. So if you're a CFO, a finance director, a tax advisor, or a lawyer advising on M&A or restructuring in the UAE, this is the most detailed walkthrough available, and it's built directly from the source legislation. I'm Shuaib from RDvault, and we specialise in UAE R&D tax credits, from eligibility assessment through to pre-approval applications and ongoing compliance. So let me take you through the structure. So we're going to start the legislative hierarchy, how these two decisions sit within the corporate tax framework, and then we're going to move through who qualifies, the 5 R&D criteria, the tiered rate structure with a worked example, qualifying expenditure in and out, the pre-approval process, clawback rules, carry forward and transfer rules, record keeping, startup specific considerations, and finally the open questions that the legislation has yet to answer. Every chapter is timestamped in the description below, so jump to whatever is most relevant to you, and let's start at the top. Now, to understand this credit, you need to understand where it sits in the legal architecture. So at the top is the corporate tax law, Federal Decree Law number 47 of 22, as amended by Federal Decree Law number 28 of December 2025. Now, the amendment specifically enables the Cabinet to create an R&D tax credit by decision. The Cabinet exercised that power and issued Cabinet Decision 215 of 2025. Now, this is the primary R&D statute. It defines the credit, sets out who qualifies, and establishes the conditions. The Ministry of Finance then issued Ministerial Decision 24 of 2026, published on the 18th of March 2026. Now this is the operational rulebook. It contains the rate table, the 5 R&D activity criteria, the pre-approval mechanism, the expenditure rules, the source keeping requirements, and the anti-abuse provisions. Now both decisions apply from the 1st of Jan 26. Cabinet Decision 215 is the substantive law, what the credit is and who it applies to. Ministerial Decision 24 is the working document, how you build and submit a claim. Now, the first question is always, does this entity qualify? And the Cabinet decision defines a qualifying entity, and there are cumulative requirements. All must be satisfied. So first, the entity must be a judicial person, a company or equivalent legal entity, incorporated or established in the UAE under UAE law and subject to corporate tax and or top-up tax. So foreign companies operating through a UAE permanent establishment may also qualify under a separate pathway in the legislation. Second, it must be subject to corporate tax and or top-up tax. Cabinet Decision 215, Article 1, defines a qualifying entity as one that is subject to corporate tax and or top-up tax. Now the standard tax rate is 9%, but it also includes multinational enterprises subject to the 15% domestic minimum top-up tax under Cabinet Decision 142 of 2024. So if the entity is outside both the corporate tax and the top-up tax regimes entirely, or has elected small business relief, it does not qualify. Now, free zone entities have a separate pathway we'll cover next. And third, the R&D activities must be conducted in the UAE. Now, this is a territorial condition. Work done offshore, even if paid for by a UAE entity, does not generate credit entitlement under this regime. Fourth, qualifying R&D expenditure must reach at least 500,000 dirhams per R&D project in the tax period. That is per project, not an aggregate entry-level threshold. So if a company runs 3 R&D projects and one of them has only 300,000 dirhams of qualifying expenditure, that project does not qualify, even if the other 2 are well above the threshold. And importantly, this 500,000 dirham threshold is calculated before the 30% staff costs uplift we'll discuss later. And fifth, and this is the one the market is not yet focused on, the entity must be beneficially entitled to a share in the returns from exploiting the R&D outcomes. This comes from Art 31D of the Cabinet decision. And what it means is that the entity claiming the credit cannot merely perform R&D as a service, it must benefit from the result IP, know-how or commercial outputs. Now, this has significant implications for multinational groups where a subsidiary performs R&D, but the resulting intellectual property is contractually owned by a foreign parent. And if the UAE entity bears the cost but doesn't benefit from the outcomes, the credit may not be available. And any group with centralised IP ownership needs to review the condition carefully. Article 3.1 of the Cabinet decision also includes 2 further conditions. The R&D project must have a specified objective to increase the stock of knowledge or devise new applications, and the entity must comply with all requirements of this decision and any decisions issued by the Minister of Council. And those are conditions E and F. They are primarily procedural, but they are cumulative requirements in the legislation. So in summary, UAE incorporated judicial person subject to corporate tax or top-up tax, R&D on UAE soil, at least 500k per project of spend, beneficial entitlement to the R&D results, a specified knowledge objective and full compliance with the decision's requirements. Miss any of those and you are outside the credit. Now, free zones deserve a specific attention. A qualifying free zone person, a QFZP, paying 0% corporate tax on qualifying income is not automatically excluded. The legislation provides that alternative pathways for free zone entities. So, pathway 1, the QFZP is subject to corporate tax at 9% on taxable income for the relevant period, and that taxable income is derived from R&D activities. So this catches free zone businesses that have non-qualifying income taxed at the standard rate. Pathway 2, the entity is subject to the domestic minimum top-up tax for the fiscal year in which the R&D expenditure is incurred. So DMTT is the UAE's implementation of OECD Pillar 2, the Global Minimum Tax Framework. It applies to businesses that are subject or part of a multinational group with consolidated revenue of 750 million euros or more. Now, for these entities, even when a free zone, there is top-up tax liability, bringing the effective rate to 15%. Now, the technical question: how does a non-refundable R&D credit interact with DMTT calculations? Well, under the GLOBE rules, the OECD framework that Pillar 2 implements, the treatment of tax credit depends on whether it is classified as a qualified refundable tax credit. And a non-refundable credit that is not so classified would normally reduce covered taxes, which could paradoxically increase the top-up tax liability. Now, the UAE legislation addresses this directly. The Ministerial Decision dedicates Article 14 to the application of the R&D credit within domestic groups subject to DMTT. The credit can be utilised against top-up tax, and Article 14.2 specifies how the top-up tax is reduced by the credit amount. But whether this domestic treatment is fully aligned within the OECD's peer review of the UAE's DMTT framework remains an open question for large M&E groups. Now, entities excluded entirely under Art 4 of the Cabinet decision: first, any entity that is neither subject to corporate tax nor top-up tax; second, any entity that has elected small business relief; and third, any other entity that the Minister may specify by future decisions. That is an exhaustive list as the current legislation currently stands. Now, the heart of the credit, what qualifies as research and development? Well, the Ministerial Decision defines a qualifying R&D activity as work that meets all 5 of the following criteria simultaneously. So, not a majority, all 5. Number 1, novel. So the activity must aim to generate new knowledge of understanding, replicating existing techniques, or adapting known methods in a straightforward way does not meet this test. Number 2, creative. The work must involve original investigation or experimentation driven by hypotheses. A product development roadmap built on known engineering is generally not creative in this sense. 3, uncertain. So there must be genuine scientific or technological uncertainty, not commercial risk, but uncertainty about whether the technical outcome is achievable or by what method. So if a competent professional in the field could have predicted the outcome in advance, this test likely fails. Number 4, systematic. The work must follow a plan and budget. So an ad hoc experiments or undocumented tinkering doesn't qualify. This requirement directly drives the record-keeping obligations that we will cover later. Number 5, transferable and reproducible. The results must be capable of being applied or replicated in other contexts. This separates genuine research from one-off bespoke conditions or solutions. The Ministerial Decision states that assessment of whether any activity meets these criteria shall be made having regard to the Frascati Manual, the OECD's framework for measuring R&D activity. Now, the statutory language is having regard to, meaning the Frascati Manual is the primary reference document, though not strictly binding UAE law. So in practice, we need to expect the Emirates R&D Council to rely on it heavily. One important exclusion: the regime explicitly doesn't cover R&D in social sciences, humanities, or the arts. Arts 3.4 of the Ministerial Decision. Now, this is a scientific and technological R&D credit only. One warning: routine software development, product improvement, and engineering work do not qualify simply because they are labelled as R&D in project documentation. The Council will assess substance, not labels. Incorrectly classifying activities as R&D, particularly where there is no evidence of genuine technical uncertainty, is one of the highest risk areas for claim challenge or denial. Now, the rate table. The outcomes from Article 2 of Ministerial Decision, and I need to correct almost every summary I have seen online, the credit is not a flat rate. It is a marginal rate, branded calculation. So different portions of your expenditure attract different rates. So Band 1, the first AED, 1 million of qualifying expenditure. The rate is 15% and the maximum credit achievable is 150,000 dirhams. Now, this requires at least 2 R&D staff on average. Band 2, expenditure from 1 million dirhams to 2 million dirhams, and the rate increases to 35%. And the maximum R&D credit is 350,000 dirhams, and this requires at least 6 R&D staff. And Band 3, expenditure from 2 million to 5 million dirhams, and the rate attracted is 50% credit, a maximum of 1.5 million dirhams. Now, this requires at least 14 R&D staff, and the maximum possible credit overall is 2 million dirhams. So expenditure above 5 million dirhams generates no additional credit, and the critical point most summaries miss from Article 2.7, you must satisfy both the expenditure threshold and the headcount threshold to access each band. And if either is not met, the rate adjusts downward to the highest band where both conditions are satisfied. So if you have 4 million dirhams of expenditure but only 8 staff, you cannot access band 3. 8 is above band 2's threshold of 6, but below bands 3's 14. You get bands 1 and 2 only. The remaining 2 million generates 0 credit, and this credit is non-refundable. So if the credit exceeds your corporate tax liability for the period, no cash refund, but you can carry the excess forward. Now, for early stage businesses with little or no tax liability, this shapes the entire strategy, which we will come on to. Okay, so let me put the banded calculations and the dual threshold together in a worked example. So here's scenario A. A UAE technology company has 6 million dirhams of qualifying R&D expenditure. They have 8 full-time equivalent R&D staff. Band 1, 8 is above the threshold of 2, so 15% on 1 million dirhams is 150,000 AED dirhams. Band 2, 8 is above the threshold of 6, 35% on 1 million dirhams, which is 350,000 dirhams. And band 3, 8 is below the threshold of 14, so they can't access band 3. Now, 3 million of expenditure generates 0 credit, so the total credit is 500,000 dirhams. Scenario B, same company, same 6 million of dirhams of expenditure, but they have restructured their R&D workforce, bringing in a combination of directly employed staff, externally provided workers, and qualifying subcontractor personnel to reach full-time equivalents. A quick note on how headcounts work here. R&D staff under the Ministerial Decision includes 2 categories in the Article 1 definition: direct employees and EPWs. Both must be under the supervision, direction, and direct control of the qualifying entity. So for subcontracted activities, Art 2.5 separately allows the subcontractor's qualifying personnel to count towards headcount. All 3 routes contribute to the headcount thresholds. The distinction matters because EPW costs are treated as staff costs, carrying the 30% overhead uplift, while subcontractor fees do not. So back to scenario B. 16 is above 14, all 3 bands are now accessible, and band 1, 150,000 dirhams, band 2, 350,000 dirhams, band 3, 50% on 3 million dirhams, which is 1.5 million dirhams. So the total credit, 2 million dirhams, the maximum, and the difference is 1.5 million between the 2 examples. So the same expenditure, the only change was workforce structure. Now, this is the single most powerful planning lever in the legislation. Now let's go through what expenditure qualifies. Article 8 through 11 of the Ministerial Decision cover these categories. Category 1, staff costs, salaries, wages, allowances, medical insurance, pension contributions, end of service gratuity, bonuses, benefits in kind, and training costs directly related to R&D activities. So the staff must be located in the UAE and under the supervision, direction and direct control of the qualifying entity. So that is the exact language from Article 8.2b. So supervision, direction and direct control. All three elements, Article 8.3 allows a 30% overhead uplift on qualifying staff costs. So if your direct R&D staff costs are 2 million dirhams, you can claim 2.6 million as qualifying expenditure for this category. The 30% is a statutory proxy for overheads. So the legislation does not itemise what it covers, and you do not need to evidence the individual overhead items, at present at least. One exclusion, employee stock options plans are specifically carved out. So an important subcategory, EPW workers, defined in Article 8.9 as well. An EPW must satisfy 4 conditions. First, they are not a director or employee of your entity making the claim. Second, they provide services through a staff provider company or as an independent contractor or service provider. The third, and this is the most important people miss, they must be personally obliged to provide the services under a contract. The statutory language is personally obliged, which in practice means the contract should identify the specific individual providing the services rather than contracting for a team or a deliverable. Fourth, their services do not constitute contracting under Article 10. Now, EPW costs are treated as staff costs, meaning they qualify for the 30% uplift and they count towards your headcount thresholds. The same supervision, direction and direct control test under Article 8.2b applies to EPWs as it does to direct employees. Now, this is a distinct and valuable planning category. Category 2, consumables. Materials and items that are directly used in R&D activities are no longer usable in their original form afterwards, so they've been consumed. This includes lab supplies, test materials, prototypes, and specifically includes water, fuel, power, and license fees for software or databases used in R&D. Now, consumables sold or disposed of in the ordinary course of business don't qualify. And consumables acquired from another member of the same tax group don't qualify either. Now, Category 3, subcontracting fees. Payments to third parties for conducting R&D on your behalf. Article 10 has set strict conditions. The subcontractor must be UAE based. The work must be performed in the UAE. The activities cannot have been subcontracted by you by another party. There's no back-to-back arrangements, and the subcontractor cannot further subcontract to someone else. So if a subcontractor is a related party, they must maintain audited financial statements as well. Now, intergroup subcontracting within the same tax group does not qualify. And one additional condition worth noting, for MNE groups, subcontracting fees attributable to a foreign permanent establishment of a qualifying entity do not qualify. That is Art 1E, or Art 10E rather. So if your UAE entity also has overseas expenditure structured as a foreign PE, this condition requires specific review. The 30% overhead uplift doesn't apply to subcontracted fees, only to direct staff costs and EPW workers' costs, as previously discussed. Now, for multinationals sharing R&D across jurisdictions, there is a fourth qualifying category, cost contribution arrangements. So your proportionate contribution to a CEA determined at arm's length and proportionate to expected benefit qualifies as R&D expenditure to the extent that underlying R&D activities are performed in the UAE. And one more category that IFRS preparers need to know is that where costs in categories A through E, which is staff, consumables, subcontracting or CEAs, are capitalised under the applicable IAS standards as internally generated sort of intangible assets from qualifying R&D activities, they qualify as R&D expenditure. So in IFRS terms, development costs meeting the IAS 38 capitalization criteria don't lose qualifying status simply because they sit on the balance sheet. Now, this is a significant provision. It means that capitalized dev expenditure under IFRS are not penalized. And across all categories, the 500,000 dirham minimum threshold applies on a per project basis, calculated before the staff cost uplift. Now the exclusions, and those matter because overstating qualifying expenditure is one of the fastest routes to clawback. First, government grants and subsidies. Expenditure funded directly or indirectly by a grant, as defined in the Cabinet decisions, must be excluded. You cannot claim tax credit on expenditure that has already been subsidised. The expenditure must also not benefit from any other tax incentive, credit, exemption or relief under any UAE legislation. Second, intragroup costs within a tax group. The entity that originally incurs R&D costs, employing the staff, purchasing consumables from third parties, engaging external subcontractors can claim those costs. But if those costs are then recharged or recycled within the tax group, the receiving entity cannot claim them. Staff costs recharged from one tax group member to another do not qualify. Consumables acquired from a tax group member do not qualify. Subcontracting between tax group members doesn't qualify. The legislation prevents double counting, not first-time claiming. Now, beyond these specific rules, the entity claiming the credit must bear the financial burden of the R&D and be beneficially entitled to exploit the results. Where a UAE subsid funds R&D but the economic return flows through to a foreign parent, that disconnect creates material risk. So the structuring of IP ownership, cost allocation, and the contractual allocation of functions, risks, and economic returns must all support the claim. Third, capital expenditure. Land, buildings, and long-lived assets falls outside the qualifying expenditure categories as published in Ministerial Decision 24/2026. Equipment and capital assets are not currently in the qualifying expense categories. The legislation does provide a mechanism under the Cabinet decision for the Minister to specify additional qualifying categories by future decisions, so this may be addressed in future guidance. For now, capital equipment costs should be treated as non-qualifying. Fourth, Article 15 of the Ministerial Decision, artificial separation of businesses. If persons have artificially separated their business and the combined qualifying R&D expenditure across the entire business exceeds the thresholds in the rate table, this will be treated as an arrangement to obtain a corporate tax advantage. The authority can counteract it, claw back any credits, and forfeit any unused credits. And now, this is a direct anti-avoidance provision aimed at entities splitting operations to manipulate the banded rate structure. Now, this is the most important procedural requirement in the entire credit. Article 4 of the MD establishes a mandatory pre-approval requirement. You cannot simply claim the credit for your tax return. You must first obtain approval from the Emirates R&D Council for each R&D project. So step 1, you submit an application describing your R&D activities, confirming how they meet the 5 criteria, and setting out your qualifying expenditure. Step 2, the Council assesses your application. Now, as of April 26, the pre-approval portal has not yet been formally launched. The operational mechanics, how applications are assessed, turned around, evidence standards are still not fully public. Step 3. If approved, and you receive confirmation. If disapproved, maybe there's a potential appeals process. Step 4. You include the credit in your corporate tax return for the relevant period, supported by the pre-approval, breakdown of qualifying expenses, the audited financial statements, and a signed management declaration. A practical point on those audited financial statements. The Cabinet decision requires audited accounts as part of every claim. There is no exemption for smaller entities. Now, many UAE SMEs and startups and scale-ups do not currently prepare audited financials, but if you intend to claim the R&D credit, audited accounts are mandatory costs of entry. Budgeting for this from the outset is required. Now, the practical implication: if you plan to claim for 2026, you need to be building the documentation now, in real time, as the R&D activities are being conducted. Eligibility is established by how activities are actually undertaken during the tax period, not by how they are described at the point of filing. Now, attempting to reconstruct qualifying R&D positions at the year end without contemporaneous evidence or pre-approval carries a high risk of challenge or denial. Now, this is forward planning exercise, not a year-end adjustment activity. So we need to start today. Now, Article 16 of the Ministerial Decision is the anti-abuse provision, where it can be reasonably concluded that an arrangement has been adopted mainly or partly to obtain or increase an R&D tax credit in a manner inconsistent with the economic substance or the genuine nature of the R&D activity, the authorities can counteract the arrangement, claw back any credits utilised, and forfeit any unused credits. The clawback window is 5 years. Article 16.2 specifies the trigger events. So if within the 5 years of the last period in which an R&D credit was claimed, the entity ceases to be a taxable person or becomes a qualifying free zone person or elects small business relief or enters liquidation or re-domiciles outside the UAE, any credits utilised must be repaid and any unused credits are forfeited. A credit claimed in 26 remains at risk until 2031. And now for M&A due diligence, any acquisition of a UAE company that has claimed R&D credits should include a specific review of the credit methodology and pre-approval documentation. And the SBR trap works retrospectively here as well. So if you claim and use the R&D credits in 26, then revenue drops and your accountant elects small business relief for 27 or 2028, the 26 credit you claimed or used is clawed back. This means no SBR election for at least 5 years after your last R&D claim. So you need to make sure your advisors understand this. On business restructuring specifically, Article 7 of the Ministerial Decision deals with transfer of credits in the context of business transfer. The transferee must continue the R&D activities for at least 2 years. If the activities are discontinued within that window, the credit is clawed back, forfeited, and penalties apply. The transferred credit cannot shelter behind other tax losses or reliefs. The message: R&D credits require the same rigour as any material tax position. The downside risk is truly real. Now, 3 provisions particularly important for larger organisations, and we'll discuss those now. The carry forward provision. Where the credit exceeds your company tax liability, the excess carries forward for future periods, and there is no stated time limit. However, carry forward is conditional on maintaining at least 50% ownership continuity, or if ownership changes beyond 50%, the business must continue substantially the same activity. Listed entities on recognised stock exchanges are exempt from the ownership continuity test. Now, with the transfer of credits, credits can be transferred between entities within a group, but the ownership threshold is 75% common ownership, and that ownership must be maintained from the beginning of the period in which the tax arose through to the very end of the period in which it is being used. The transferred credit must be used in the period of transfer. It cannot be further carried forward or transferred by the receiving entity. Finally, tax groups. Where a tax group exists, R&D expenditure and staff headcounts are aggregated across all qualifying members. The credit is applied against the consolidated group tax liability. Pre-grouping R&D tax credits arising before an entity joined the group are utilised first. If a member leaves the group, the credit stays within the group except for any unused pre-grouping credits. The parent company is responsible for pre-approval and claiming, and if the tax group applies for a credit that is later found to be invalid, every member is jointly and severally liable for the clawback. Now, Article 12 of the Ministerial Decision sets the record-keeping standard. All records supporting an R&D credit claim must be retained for 7 years following the end of the tax period to which they relate to. So a credit claimed for 2026, records must be kept until at least 2033. Written documentation, project plans, objectives, research protocols, experimental designs, progress reports, and management sign-offs. Now, with visual and technical records, lab notebooks, test results, photographs of prototypes, engineering drawings, software version control logs, and with electronic data, all digital records must be accessible to the Federal Tax Authority and the Emirates R&D Council on request. Now, contemporaneous evidence is the gold standard. Records created at the time the work was done, not reconstructed afterwards. A project log created 6 months later when an audit is looming is worth considerably less than a notebook entry from the day the experiment was run. The documentation must be sufficient to demonstrate both the technical bases, that the activities meet the 5 R&D criteria, and the financial bases, that the expenditure is properly calculated and linked to qualifying activity. Now, these two threads must connect. Technical documentation without financial backing or financial claims without technical evidence will not sustain a claim. The 7-year retention period extends beyond the 5-year clawback window, giving authorities an audit trail that outlasts the challenge period. Now, everything we've covered applies equally to profitable companies and early stage businesses, but there are specific considerations I need to address. The small business relief trap. Under the Cabinet decision, entities that elect small business relief are excluded from the R&D credit. If you elect SBR for 2026, you cannot claim the credit for 2026. There is no mechanism to reverse this either. Elections for 23, 24 and 2025 are irrelevant. The R&D regime only applies from 2026 onwards. The 2026 election is the one that matters. The mistake happens when accountants automatically file 26 returns on the same basis as prior years, ticking SBR again out of habit. The first 2026 returns are not due until approximately 2027. So that sounds like plenty of time, but it isn't. The decision must be made now, before anyone touches the return. So if you are a UAE business conducting R&D with revenue below 3 million dirhams, do not elect SBR for 2026 without first assessing your R&D credit position. Now, point 2, the carry forward is not a consolation prize. It is the strategy. A startup with zero tax liability in 26 earns the credit but cannot use it immediately. The credit carries forward with no stated time limit. Think of it as a credit bank. Now, a company spending 1 million dirhams on qualifying R&D with 2 staff earns 150,000 dirhams per year. And after 3 years, that is 450,000 dirhams of accumulated tax credits. The moment the business turns profitable, the credit bank depletes the first year's tax liability, and so on and so forth. The benefit arrives exactly when the business needs it most. So quantify it now and document everything if you're going to make an R&D claim. Point 3. Funding rounds and ownership continuity. Carry forward requires at least 50% ownership continuity, or if ownership changes, the business must continue substantially the same activity. For startups approaching a funding round, where founder dilution could push external ownership above 50%, this requires advanced planning and thought. The same business exemption should apply to a genuine R&D-led startup, but it is not automatic. Confirm it before the round closes. Point 4. Headcount for the lean teams. The ministerial decision requires assessment of R&D criteria to be made having regard to the Frascati manual. Now, the Frascati manual recommends that individuals spending less than 10% of their working time on R&D should not count toward headcount totals. An engineer dedicating 1 day a month to R&D almost certainly does not meet your minimum 2 staff threshold. So use the 10% baseline as your starting position when assessing headcount eligibility. And these points apply to early stage businesses, but the legislation is equally relevant to established companies and enterprise groups as well. Now, the IP beneficial entitlement condition, the tax group aggregation mechanics, the cost contribution arrangements for M&Es, sharing R&D costs across jurisdictions, and the interaction between the credit and the 2-pillar DMTT obligations all require structuring at an enterprise level. The credit is designed for businesses of all sizes, and the planning opportunities scale accordingly. Now, I said at the start I would cover what the legislation does not yet answer, and here are the open questions as of April 2026. First, the pre-approval portal. The Emirates R&D Council has not yet launched the formal application portal. The form, the turnaround time, and the evidence standard remain unpublished. Second, the Phase 2 refundable credits. The Ministry of Finance has publicly indicated that refundable R&D credits are being considered as a future development. This would transform the value of the credit for pre-profit businesses. Now, no timeline has been given. Now, thirdly, subcontractor headcount mechanics. The precise FTE counting methodology for mixed function subcontractors and the treatment of partially UAE-based work. And the fourth, the interaction between the R&D credit and DMTT calculations for large M&E groups. Specifically, the classification of the credit under globe rules and the alignment between the UAE's domestic mechanisms and the OECD's peer review framework. Now, we at RDvault work exclusively in the UAE tax credits. We help companies assess eligibility, structure pre-approval applications, build expenditure calculations, and manage ongoing documentation and compliance programs. Visit rdvault.ae to book a call. The link is in the description. Subscribe to the channel as the portal launches and further guidance is issued. We will come back again to cover every update. Thank you for watching.